Welcome to the First Down Legacy Podcast, your gateway to the exciting world of multifamily real estate investing. If you're eager to discover the strategies, insights, and success stories that will take your investment game to the next level, you've come to the right place. In each episode, we delve deep into the multifamily investing arena, sharing expert advice, interviews with industry leaders, and valuable tips to help you build your own legacy through multifamily real estate. Whether you're a seasoned pro or just starting out, our podcast is your playbook for scoring big in the world of multifamily investing. Join us as we explore the ins and outs of multifamily properties, uncover the latest market trends, and learn from those who have already achieved remarkable success in this dynamic field. Get ready to huddle up and tackle multifamily investing like a pro. This is the First Down Legacy Podcast, where your journey towards financial prosperity begins. Let's get started. So welcome, Igor Shaltanov, CEO of the Avista Fund. It's an honor to have you here on the First Down Legacy Podcast, and to connect with you on such an early, on such an early time here on a Monday morning. How are you?
Yeah, I'm doing well, thank you. Great to hear everybody, right? And then we'll be happy to share experience as much as I can. So I'm always glad to connect to people.
Amazing. Yes, so essentially that's what we do here on the First Down Legacy Podcast. We connect with the experienced individuals like yourself, to kind of just lay down the roadmap of how you began and how someone who's looking to get into multifamily or just to syndicate, overall, on how they can begin their process.
Yeah, so thank you for having me, my dear, right? And thank you for naming me very experienced. Still a lot to learn, I feel like. And I think the starting block, right, and the starting steps, it's a mental shift from, and again, I'm talking from my personal experience right now. It's mental shift from working and doing with your hands and going into your, actually thinking and mental work and saying, okay, how can I bring more value to people without, let's say, digging the dirt, right? Making that example, right? Which is keep it simple. And, with that mental shift, right, you start to understand there's so much value you can bring to the table, and you have to choose the specific niche, right? Mine was real estate back then. So, because I had the business, and I wanted to be always kind of not just managing the people, not managing the company, but managing the capital, which for me was the next step of development. And with the managing the capital, the idea was, okay, what's the most capital intensive business in the United States? And it's real estate, right? Because there's trillions of dollars inside of real estate, number one. Number two, it's a higher leverage business. And the only way we can make that much of the profit, I would say, because it's high leverage, right, through the banks. And then banking system, it's very favorable if you come to the bank and say, give us a loan for this type of building or that type of house, and they will give you a loan, right? But then if you come to them saying, okay, I got a brilliant business idea, can you give us $10 million? They say no immediately, right? Because it's high risk for them, and the failure rate is 90% or so. So basically what I'm saying is you just focus on that mental capacity of yourself, and you start to understand how you can bring value to the table internally, right? Because there's so many applications. I'm talking about real estate, right? You can be finding property, you can just do the property management piece, you can be the earnest money, capital money. There's so many ways you can be valuable to the partnership, right? And that was my first shift.
Okay, amazing backstory there. Yeah, so you're that with your experience there as far as raising capital, I see you're the founder of Avista Fund. You take me down the road as far as what kind of approach do you take when initially getting started as a capital raiser?
Again, I will speak from my personal experience, and I believe the best approach was I was doing something which is very important for myself first and for my partner. So I have a partner in my business, and his name is Nikita. And the internal itch was we got to invest our own money with the less risk possible and the highest return possible. So the risk adjusted return was always on the table, saying, okay, how we can get more, right? Capital appreciation was the last risk. And then it was the real estate, number one. So, and then through the real estate of single family, right? And condos and houses and all that stuff, both of us actually, so we've been through the same kind of, I would say, cycle of the history, right? So we bought some single units, and then, so we got duplex and fourplex, but then we understood it's very, very high intense management piece, right? Which just comes with that ownership. And we shifted our mind into the larger, like the larger, I would say, application of real estate, which is syndication in apartment complexes. And all of that makes sense because it's just a single roof, right? And you got so many families and you got so many units, and you can scale that model to the point that could be like, again, $100 million, right? It could be like $1 trillion. You can place any capital into the real estate. So basically, having that in mind, we said, okay, what could be beneficial to the syndicators, right? For the people who wants to be doing the operational side of it, who wants to be like day-to-day management of it, and then you do need the capital, right, to close the deal, because it's high leverage, right? You can get 70% or so from the bank, 65, 70, right, from the bank, and the rest of it should be coming from private investors, right? Because you're going to be at a certain point depleting all your capital and still having those really good deals or maybe diamond deals on the table, but you can't close the deal because you don't have a capital, right? So you don't have a means of capital, right? And then, so that's where we come and play and would say, okay, we're going to become a capital partner with you guys. And then, so we're going to look at the deal. We're going to look at the structure, right? We're going to probably bring some ideas, right? And expertise from the previous deals, because now we have the 20 plus deals as of today. And we're going to bring so much value, and besides capital I'm talking about, and it's going to make us very successful partnership.
Okay, so you did mention, with you and your partner, you started with residentials and duplexes. What does that timeline look like as far as when you first began on the smaller end of it, fast forward to operating or owning 50 plus units?
It started very, very small back in Russia and Moscow. So, and I had a spare apartment. So, and my mom was not familiar with the real estate renting, right, side of it. And I said, listen, we can make it work to the point you're going to be like earning the salary of yourself, right, per month, but just renting that spare apartment. And she was very new to that, right? And it was new for me. And then we said, okay, let's do that. Let's remodel. And I said, I'm going to remodel the whole thing. And I'm gonna move you to the brand new unit, right? And then that old unit we're gonna rent to the people. And that idea was impossible first. And then once we complete the project and the money started to come in, it became like very possible and very like tangible, I would say, right? And you can touch the money and they coming in on the bank account. It was cash, by the way. So, and you just stop by and you pick up that pile of cash and you're like, wow, that's a powerful proposition, right? So if you multiply those by 10, right? So you're going to get 10 incomes basically, right? Yeah. So basically what I'm saying is, so that's first spark the idea of, I wouldn't call it passive income, but it's just a less workable income. You don't need to work as much, right? And you receiving that income, but you need the capital in the beginning, right? So because I was a professional athlete, I did have a capital. So, and I did have spare capital always to invest either or to remodel or to work on that project. But then because of those single units, they start to accumulate. I got 1 and 2 and 3. And then now, and again, it's all cash in Russia. So, and now you got this capital, and then you can make different decisions because you're not relying on the profits anymore. So you can say, okay, from and again, backstory a little bit, right? I was really saving money in the beginning, like really saving and building that wealth, I would say, or building that nest of cash. And I didn't know what's the better choice, right? I didn't know what's going to be the best application of that capital appreciation, where my money is going to work the best.
Right.
And I started to research those things. And again, I tried it, the stock market, I tried different PE and all that stuff, like private equity investments. But then the risk was so high, and then the return was, questionable, and the time frame is huge as well. So, and then on the stock market, the return was such the minimal, right? If you look down the history, and then the ups and downs of that nature, right? It was like huge, right? You wake up and your portfolio, like say 10%, 20% down within the month or so. And then you got to be like holding yourself really well, because you got to wear anyways, and it's a roller coaster, emotional roller coaster all the time.
Of course.
And there's
Yeah.
no tangible, basically, certainty of, okay, you know what, if something went wrong, so I have this piece of something, right, which is going to be basically the backup for that plan. So in real estate, it's all different, right? Even so, the market is down, but you do understand you have a great building, you put your soul and heart, right? Your soul and heart into that building, so you remodel that. And again, I was never being creepy landlord and doing the cheapest. I was like really doing the not expensive, but quality stuff,
Yeah.
right? And I know if I put a little bit more quality, it's not going to break. I don't need to come back. I don't need to fix it every single day, right? Still was a lot of management pieces, but again, so I was always like going after, okay, I'll do a little bit better than the rest of the market. So, and the people will recognize, and I want a tenant who's going to be paying. I don't need to serve him notices every weekend, every month, right? So, and
Yeah.
then, and people were responding to that quality. People were like choosing that quality over something like different, right? So, and again, because of that experience, it's built to a certain point, and then I start to make decisions. Okay, what is my ROI on my investments? It's not savings anymore. So, right, because I was able to save a certain amount, and I was start to think, okay, what is the ROI at what speed my capital doubling, right? Is it like 1 year, 2 years, or like 20 years? And you might be not in a good place, right?
Yeah.
And then some of my capital was like very slow in appreciation, maybe methodical, right? And maybe not as risky, but again, so it's going to take me to where I want to be. Let's say, let's make assumption, I want to get $100 million, right, net worth. So it's going to take me like 20 years, not 20 years, sorry, 20 lives to do that. It's really need 20 lives if you start to multiply that, right, by a certain amount. And
Yeah.
I said, I want to speed up that process as much as possible. And I want to mitigate the risk, because again, the first idea is not to lose, right? If you're not losing your money, so you're going to get to your goal. But if you're losing the money, you're not going to get to your goal, because of whatever the multiplier is. And again, and from that point on, I start to think through, okay, ROI, what's the return on investment, and what's the time frame? And the syndication in the real estate and different deals, which is, again, some of them you can find 2 years, some of them 5 years. So you can play, and then you can choose that path and stick to that path and get to your goal, right? So that was kind of next step.
Okay, so you talked a little bit about how you were able to save some capital as a professional athlete. What kind of mindset did it take there, to transition from an athlete, right, to always wanting to perform and to succeed at the highest level, to now being able to transition that into real estate? Can you talk a little bit about that mindset?
Oh yeah, for sure. Thank you for the question. Great question, Matthew. I think one of the important things was when you playing the sports, you I would say it's artificial world. For me, it was artificial, because you never, I would say, you never negotiate to the business owners and the contracts, and you don't talk to your employer as much, right? There's a management for sure, right, on the team, but
Yeah.
really, you playing that game, you love that game, and you've been doing that for the last 20 years, and at the end of the month, the cash coming in, right? And a lot of times, all of your necessities and expenses are covered by the team,
Yeah.
which is another artificial setup, right? Never happens in the real life. Sometimes it does, but never happens in the real life, especially in America, right? And then basically, all the money you have at the end of the month, at the end of the year, right? It's a money to play with, work with, you name it, buy something, right, and stuff like that. But that mentality was, it was very tough path. Why? Because on the TV, on the social, on a general narrative, right, anywhere in the world, it's like a flash in the best cars, and it's the buying like gold chains and all that stuff. So, but you do gotta go hard against the herd, and then you gotta start to talk to the people who actually build the wealth, and then so you start to congregate with certain groups, and then you just ask them, and then what do you actually do? You guys actually buying the chains, right, and diamonds, or are you doing something else? So, and all of a sudden, the people are in my circle, right? The people who were very successful, they were very, very conscious of what they spending on, right? And they were conscious on what's the, daily spending looks like, on the yearly spending. They can do emotional buy-in purchases, but it's going to be more like on travel, right? And building something like for the long term, I would say the memories and stuff like that. And they will buy the expensive cars, but will never flash them on the social, never flash them, because they don't want them to be, spotted, right, and stuff like that. Anyways,
Yeah.
what I'm saying is I start to pick up that mindset and saying, oh, there's something. I start to kind of be suspicious of what's the one thing on TV and what they preaching us, and then the other thing is just the real world, and the real world applications are different from the TV and social narrative, right? And that was my first mental separation from going where everybody's doing certain things, and going to that 10% of the people who is not screaming on the street what they're doing, but they actually building the wealth, and they quiet, and then they get accumulating themselves every year, right, and double their, wealth.
Okay. So adopting that mindset, that's important. So as a beginning as a in the multifamily space, I began moving and learning about this year, right? So trying to connect with immediate family and immediate friends, it's a concept that they've never heard of. A vehicle to building wealth that they're not comfortable to or accustomed to. So what kind of networking or education did you first begin acquiring, right? As far as reading books, meetups, and networking and things like that. What that were essentially able to catapult you to the next level in your business.
Good question. So I think the first, because I was a business owner, right, and the first I would say the first stage of development was talking to the business owners, and then picking up out their brain, what do they actually do, and then how they do it, and then the management piece of it is huge as well, and then it comes with managing emotions as well at work and outside of work. And then the next step was, okay, if you if you structure your life certain way, so you have a more money, and again, it doesn't matter how much you make. So one thing
Okay.
is, I really understood it does not matter how much do you make, but it does matter how much you keep at the end of the month, right? So
Yeah.
meaning you might be making $10,000 a month, right? But you spend in 12, and that's going to be tough, right? To do something with that. Why? Because you're really in a constant mode of putting the money away from yourself, right? And just buying out yourself from the trouble, right?
Right.
But then if you're making $1,000 a month and you're spending $500, right? That means you're saving or setting aside, not saving, I don't like that word, saving, setting aside $500, right, per month. It's going to be 5,000, 6,000 a year, right? And then that's going to propel you to the mentality, okay, if I got and again, maybe in a year or two, not right away, if I got $6,000 on my account and they just sitting there, there's got to be a way to multiply this, right? There's
Yes.
got to be a way to grow it, and that's the first mental kick. And then, okay, and then once you learn how to multiply 6,000 to 6,500 without doing any work, but really making the good decisions, the right, bold decisions, taking that risk. Because again, another piece of it. So you got to take the risk. There's no reward if you're not taking the investor. The the reason investor making the profits, because he gets all of that risk. right, on himself. He burned that risk throughout the investment period.
Yeah.
That's his reward. So you exchange your value, the money at this point, right, to the risk. And once you send that wire to the, let's say, fund, right, all you have is just the risk. So you
Oh
just got
yeah.
you so big risk, right? And you hold that risk and you saying, I'm not going to drop it, right? I'm going to carry that risk for the next 5 years, 3 years, right? And then, so at the end of that, you exchange that risk to reward, right? And that's a great analogy. And then some people not even ready to do, they hold this, let's say 500,000, right, or so, and they, I don't want to take that risk. And so why would you ask for reward? Like there's no
Wow.
something for nothing. I was like, there's no way you can have no risk and be rewarded at the end, right? So then
Right.
stay with 500,000. That's exactly what you ask for, right? So what I'm saying is that's the second, I would say, development of your brain, my brain, I would say, again, I would say about myself, right? So it was very scary in the beginning to take
Oh
that
yeah.
trust and then, to send the money somewhere, right? But then once you do like 5 times, you're like, oh, it's not a big deal, whatever. If I lose it, that's fine as well, because I know exactly what I'm going to get if it's going to be all good, all perfect, right? All as a business plan, right? Planned before. So what I'm
Yes.
saying is that the next step of, taking that risk, but now really building that knowledge of assessing what the risk comes from, right? Why it's risky, and then maybe some of the things are a lot more risky than the others, right? And then at the age of, let's say, I'll say 5 years old as an investor, I'm talking about, right? If you
Yeah.
5 years old as an investor, right, you start to really understand, okay, so this might be a little too risky for me. This might be a little less risk, and I'm not willing to take that little risk. I want to get a little bit more, right? And then return will be a little bit more. So anyways, you start to really understand, and then you start to base it on your personal experience, right? So you want to be here, or you want to be there, or you want to be somebody even different operator or different idea, right? And you want to be in, maybe venture funds and all that stuff. Anyways,
Okay.
that's the one of the development stages as well.
Excuse the interruption, but I have a very important message for each and every one of you. If you've made it through the video this far, it could only mean that you are ready to take your multifamily career to the next level. If you book a call with me in the link below, I can show you step by step on how I've been able to create passive income, build a legacy I've always wanted, and turn my dreams into a reality. Book a call with me now, and I too can show you how to align your purpose through multifamily investing. Let's go. Yeah, man, you talk about in the beginning it can be very scary. So I recently invested into a 5 to 6 year business plan, right? It's a 200 unit out in South Carolina. And that's my very first huge investment. It was more than 70% of my net worth, so it's very scary, man. But again, the mindset changed to, it's like, okay, let's invest this money today to, right, for a bigger reward in 5 to 6 years. But how can we multiply now? How can we continue this growth today? And a lot of people, like you said, they want to hold on to that. They don't see at least it's not comfortable for them to take that risk uh, for a bigger reward. So that's something that I definitely had to come to terms with, as far as removing the emotional side of things from it, and it's purely a business decision.
Yeah.
Yeah, 100%. Okay, so can you tell us a little bit about any current projects that you're working on today or looking to work on in the near future into 2024?
Yeah, thank you for that question. So we got so again, there's a scope of that risk again factor. So and then the 70% of the portfolio of the fund, it's always focused on multifamily, right? And the reason why, because it's a big by size, right? It could, I would say, swallow any capital, right, available. At the same time, it's very secured. Why? Because there's tangible asset, there's families, and it's just separated between, let's say, 100 families, right? And then it's very, very hard to lose it unless it's mismanaged or just something drastic happen, right, on the market. So that's why the majority of that going into the multifamily always. But then we get another two pieces, and it's about 30% of the portfolio, right, of the capital, because people, once they, let's say they got through a couple full cycles and they get the dividends, and they start to feel more comfortable, right? Because once you get more capital and once you get less stress, right, you start to feel more comfortable, right? And then people usually ask, okay, where else we can participate, right? We understand real estate, so we know that game. We still part of that game, but we want to, take a little bit higher risk with a 10 or 20% of our money. And then there's two pieces we found super fascinating. One is application of land entitlement, not development, but entitlement. And why? Because we did multiple projects, which is ground up development. All of them are very, very unknown. I would I would not say risky, but they very unknown and they very unpredictable as well. It was the nature of, oh, you got to get construction, you got to go through approvals, you got to go through grading, weather, labor. It's just so many unknown factors. Not just one. It's like a three, four, five of them, right? By the time it's come together, all pieces, it's gonna take you a lot of times like a double of the time frame, number one, double of the budget, number two, and then double of the nerve and headaches and all that stuff, right? Why? Because once you start to dig, everything changes, right? Once you start to construct, everything changes, right? Once you start to, basically going into the final stage and you want to do, all of the occupancy breakdowns, right? And try to get new clients and then retain all the stuff. That's unknown as well. There's a lot of troubles, right, with the development. And we said, okay, what if we're gonna do just a first piece of it? What if we're gonna focus on the land entitlement? So there's a raw land, there's no loan on it, right? There's no leverage. And we can just entitle that land to the bigger developer, right? And then the
Yeah.
bigger developer game is just to build. They're not in the game of entitlement and waiting on the land and then pulling the permits and connecting to the local government and stuff like that.
Right.
So we found a partner who's like working just on one thing for the last 40 years in California, and then he's just doing the entitlement of the land. Meaning they might influence and change the zoning, right? They might just annex the land into the city, right? They just doing such a brilliant, I would say, ideas which nobody sees from the side because they had the 40 years of experience and the certain tools, right? And certain influential right connections, they can just change that project into something bigger. So we did that, right? And then, so we're working right now on the second piece. We invested in multiple private equity firms. Again, very specific. It's organic food
Okay.
companies, $10 million or more. So meaning, so they went through the death valley already. So because the statistic is absolutely insane, right? 90%, 90+% of the companies, they will never break $1 million revenue in the world. We're talking about in the world. So and then
Wow.
only 4% of them will break will break $1 million, right? And then
Yeah.
I would say like don't quote me on that, 0.1 will break 10 million. So basically we just pick and choose the organic food company, which is already distributed, right, to Whole Foods, let's say, Trader's Joe and all those big chains. And all they need just to expand their operations, right, to double, let's say, a facility, right, or maybe double distribution and stuff like that. So
Yeah.
that's another market. And then right now we're currently working. It was a land which is in the Lake Elsinore, and we have a piece of land for 285 units for the single family houses, and
Okay.
they ready to go. They just ready to build. So we buying as for $11 million. We have an appraisal on hand for 26 million as is right now, and
Yeah.
then we just need the equity, right, to just acquire that because it's under contract right now. Acquire that and then sell it to developer. Very simple. Again, is it risky? A little bit risky than multifamily? Probably yes, right? Is it big returns? Yes, of course, right? That's why
Of
you
course.
bear that risk. And then, but can you lose money? Probably not. You got 11 million purchase price, 26 appraisal as is, right? It's very hard to lose, right? But at the same time, like I said, it's a little bit risky because there's no cash flow, right? There's nothing coming in, right? It's just a rolling it and stuff like that. So this is what we're working right now currently, and then it's exciting because people, like I said, they getting kind of I wouldn't say bored, but they getting very satisfied and they getting very secure with the classic multifamily investments, and they say we want to get some spice right into the game.
Yeah, man. Talk about, those acres out in Lake Eleanor. That's very an attractive place here in California, correct?
Yeah, it's in California, and then the reason why, because a lot of people they say, okay, where are we gonna leave? We don't want to leave, let's say, in LA, right? And
Yeah.
I don't know, Hancock Park, right? It's too many people. So we have 5 bedrooms, let's say, the price house 3.5 million, right? We want to retire. The kids are gone, right? And stuff like that. We want to move somewhere like a quiet place. They moved to Lake Elsinore, brand new house, 500,000, right? Plus, and they
Yeah.
got beautiful lake view, right? So they sold their house for 3.5, bought the house for 700,000, for example, brand new. There's
Yep.
no maintenance, no, like they in a quiet place, and they got all the necessities, the parks, and shopping, groceries. And so, yes, it's a little bit far away, but then so is it, right? Because they got another $3 million or 2 point something right on account, and they can do whatever they want. They can travel, go to see kids and stuff like that. And this is the choices people are making last couple of years, and they just
Yeah.
moving out rural area, right? Putting that money on a bank account, right? And then just retiring.
I love how you've envisioned the future with that project already, and that's exactly what's going to happen here moving forward, right? As Los Angeles gets more populated, um, the rents and everything keeps increasing. Of course, and people who are looking to move out of that lifestyle will relocate in places like Lake Eleanor. So with the Vista funds, can anyone invest into that, or is that just an accredited investor fund? How does that work?
No, it's possible. It's fine. For example, for Lake Elsinore right now, we already fully subscribed. I didn't even advertise the deal, so it might be a little
Wow.
too late. Yeah, because it's very attractive. But we do
Congratulations.
think, yeah, we do get about maybe every 2 months, I would say. Every 2 months, we want to make sure we find a really good deal. And the deal before was at Kansas City, and again, eh, speaking of that dime, we're trying to find very attractive proposition or narrative why we would go down there, why would we invest in. For example, just again, quick observation: the Kansas City Overland Park. When you land in the airport, Kansas City, it's a normal city. There's nothing specific. There's nothing like I would say super attractive, right? Going from airport to the downtown. But then as you enter the Overland Park in Kansas City, it's a brand new development. It's like a brand new city within the city with a
Okay.
wide, beautiful streets. And you got the idea was they will building right the walkable communities for people who can leave, entertain, shop, and then spend some time with the families and kids in the same like neighborhood. And
Yeah.
then for the last 10, 15 years, they developed that overland park. And then I was like driving there and then walking there. And then the feel of it just amazing because you got $1 million beautiful houses right on the left side, and you got the theaters and the restaurants on the right side. And you can walk from your house to that restaurant and you just come
Okay.
back to pick up the car. So, and they got this project going, right? So basically, for the last 15 years, and they got to start to build those communities, multifamily communities. We got 200 units townhouse with a 3.9 assumption, right, from the last lender. I mean, from the last owner.
Yeah.
So we assume that loan at 3.9. There's there's no brainer, right? If you got this such as a beautiful loan, right? And you got a time frame, and you can finish your plan, right? And then you can just resell that product, right, to the people. So again, we're just looking at the risk-adjusted returns. We said, okay, this is a really great opportunity.
Yeah.
And the same moving to the land. So we found that extraordinary, I would say, piece of land, but not just that. We got an appraisal from very well-known company saying, so you guys buy them for 11, but the actual value as is on the market 26. Again, those doesn't come often, but it's very important. You find those very important, like narratives, like you find those selling points when you can say, okay, we're going to jump in. And like I said, every 2 months, I would say we're able, because we have an extensive net, we build a huge network of operators and the people who's actually, constantly operating and doing the deals. And then we reaching out to them saying, so what do you guys have? And again, not to say about our partners, we invested already, we placed the capital with them already. We know exactly how they operate, the team looks like, and then what they're capable of, right? And again,
Correct.
maybe 5 of them are not up to the, not up to the Avista Fund expectations, but then 15 of them, or one of the 15 will do the deal. I would say every 3 months, they will do something. They will.
Yeah.
Some of them will not work, but some of them are really good, and we should jump in, right? And you guys always become Avista Fund. The I would say the email, right, marketing piece of it, right? I would say the subscriber, and then you'll get the notified when the next one available.
Yeah. Okay. Amazing. Thank you, Igor, for telling us, what the future plans look like for you guys. And in the recent deal in Kansas City, hopefully, we're able to continue this connection and, partner on future opportunities to come. So we connected on Raise Masters. Where can the people find you and learn more about Avista Fund?
So there's a couple of ways to do that. One is, so we did the unique URL, right? So we can send you the ebook, right? And we were working on that last couple of years. So the ebook you can get into winrealestate.com, winrealestategame.com, right? Again, so winrealestategame.com, that's a website which is dedicated to that ebook. You can fill out the form, you'll get that ebook. And then secondly, it's going to be igor@avistafund.com. You can always visit our website and download some materials. There's a bunch of learning materials if you're new to syndication. So you just go through the website, right? You'll find very helpful information there.
Amazing. Well, again, it was an honor to have you on the First Down Legacy podcast, Igor, and I wish you a great rest of your day. And I look forward to connecting with you very soon.
Thank you, Matthew. Thank you very much. Right. Talk to you guys
All right,
now.
brother.
Thank you for having me.
Take care. Thank you for joining us on this episode of the First Down Legacy Podcast. We hope you've gained valuable insights and inspiration for your multifamily investing journey. Remember, your legacy in multifamily investing is within reach. Keep learning, keep growing, and keep building your success story. We look forward to having you back with us for more game-changing strategies and stories in the multifamily investing world. Until then, keep the momentum going and keep building that legacy. This is the First Down Legacy Podcast. Thank you for listening, and we'll catch you on the next episode.